Right, I think so. Thank you. Very pleased to have Nicole joining us from Australian Sustainable Finance Institute, Finance Institute, I should say. But I would like to also start, as we do, by acknowledging the traditional owners on the lands of which we're meeting, and obviously people are joining from all over Australia and maybe beyond, but pay our respects to the Whadjuk Noongar people who are very important in the energy transition, and obviously we recognise their contributions here at Curtin and the way that we interact with them. As we've done with previous webinars, we would ask people if they've got questions to put them through the Q&A, and I will get to those at the end. So Nicole is going to talk for about 20-25 minutes actually, and then we'll open up to questions. So that's the format as per always, and any conversation or ideas you're welcome to put them in, but we will not sort of interrupt as the presentation goes. I also would like to put a shout out to Kylie Turner from Climate Works, who fortuitously connected us when we were actually, Nicole and I were on a panel session a few weeks ago, and I think there's some great, so we're very privileged to have someone like Nicole share her expertise. She's been instrumental all through ASFI, sort of working with bringing together this taxonomy that hopefully can move the agenda forward. And I guess it would be remiss to not recognise that, with the election results, it's pretty exciting for climate change here in Australia that the agenda keeps going and things move forward. I unashamedly say that because I think it's really important, and one of the things that comes up a lot is the finance, and so we're so fortunate to have Nicole. So I'll stop talking and hand over to you. Thank you, Nicole. And people in the background, I'll be sorting out my technology, so I apologise. Okay, thanks.
Thanks very much, Peter, and it's really a privilege to be able to speak to your audiences today. It was fantastic to be able to meet you a few weeks ago and then to come back and hear about really kind of the thinking behind what's happening, particularly on the West Coast. I think here on the East Coast, we do get a bit NEM-centric in terms of the energy transition, but really getting an understanding of those complexities, but also the massive opportunity that is Western Australia is well positioned to take advantage of. I think for me, also just acknowledging the First Nations peoples and traditional custodians on the land on which I am. So I'm here on Ngunnawal country in Canberra, and I'd like to pay my respects to elders past and present, and also just acknowledge the significant contributions that First Nations people have been contributing to the sustainable finance agenda over the last couple of years at ASFI. Just a little bit, sorry, I keep flashing back, a little bit about who we are, because I'm assuming that not everybody has heard of ASFI, the Australian Sustainable Finance Institute. We were formed off the back of what was quite a significant industry-led collaboration back in 2018 that really was thinking about how we can shift the financial system to make it work for what we need in the energy and economic transition of our times. This is the biggest transition that I think has been undertaken, certainly since the Industrial Revolution and the Reconstruction post-World War II, but it has some quite unique features in that we have an existing system from an economic point of view that works quite well, but it doesn't take into account the significant externalities, and as such is not sustainable to our economic well-being over the long term. And so how do we actually reimagine the financial services system to ensure that it does take that into account, reprice risks and re-recognize opportunities? And so ASFI was initially an initiative that put together was over 90 organizations from across the full financial services spectrum, as well as academics, government and others, that really thought about what would a roadmap look like if we needed to re-gear the financial system to be able to account for what I've just explained and shape it in a way that we have a sustainable, resilient and inclusive Australia over the long term. That came out in 37 recommendations. One of those recommendations is that we be formed as a permanent institute to really keep that accountability mechanism going, to be able to help work with industry and government in partnership to drive those reforms that are needed. So that's sort of our background and where we come from. We are member-based, so we have over 40 of Australia's largest financial institutions across the full financial services spectrum. So we don't we're not a peak industry group. We don't kind of work in superannuation or in banking. We have membership across the full spectrum, which is really important when you think about all the levers that need to be pulled to finance the energy transition. But we are a not-for-profit. We have an independent, non-executive board. And our members are really signing up to that future vision. So membership is really to say we support this, and I think that's really important and has been very impactful and powerful in terms of the way in which we've been engaging and acting as that bridge with government to bring the expertise and influence of private capital to bear on helping to solve these sustainability challenges that we all face. So that's kind of who we are at the moment, and our membership, and importantly includes also some of the key government institutions, including the CFC, NAIF, others, so key financing institutions in the chain, as well as some of our sovereign and sub-sovereign funders as well. Importantly, we also play a coordinating and convening role, so working with our financial regulators, so APRA, the Reserve Bank, ASIC, and the Australian Treasury, ensuring that they are plugged into the system, because we really do see this as a public-private partnership to enable the environment for private capital to flow, and working really closely with others in the financial services system that play important roles. More focused, because we do actually have a broader agenda that crosses off on other sustainability objectives. But for our climate change mitigation perspective, we have very clear impact. So the North Star that we are chasing is mobilising private capital for decarbonisation in Australia and beyond. And I say beyond because we talk a lot about supply and demand. We can build, but we are inherently an export-orientated nation, and the things that we build, we want to export. So decarbonising not only within Australia, but looking at those future markets that are going to be the demand and the pull factor for our green exports, etc., is also critically important. So we do take both a domestic and an international lens in terms of the work that we do. I think this slide really, I think we all know these statistics. We need to exponentially grow the finance that is needed to increase finance to be able to fund the energy transition and meet our decarbonised, Paris Agreement goals. And financing the energy transition it is a catalyst that's going to enable the unlocking of other decarbonisation across the whole sector. So it's critically important that we get that money flowing. And even more importantly is that a lot of focus is happening on sort of government balance sheets, particularly over the last couple of years with the IRA, or the Inflation Reduction Act. There was a lot of incentives flowing around. But if you actually look at where the numbers are coming from, most, if not the majority of investment, particularly in the energy transition, comes from the private sector. So over 82% of clean energy investment in advanced economies originates from commercial financial solutions and corporations. So increasing, and that is where that pool is there. It is almost infinite in terms of the amount of capital that is available. But it's about how do we channel that capital in increasing amounts towards the energy transition. We've identified a couple of different challenges as to why that capital is not growing, or what's going wrong in the system in terms of those flows of capital. Of course, the volume. So there's not enough of it coming in, but importantly, there is also a lot of money and capital still being invested in assets that if we know we need to get to net zero, if we're investing in some of these existing infrastructure and assets in high emitting areas, there is going to be a lot of stranding that is going to be happening. So a lot more needs to go into a decarbonised environment, and there's still too much going into existing infrastructure that ultimately is going to have to transition away, which then begs the question, what happens to especially new infrastructure that's been invested in that is not aligned to the energy transition? From a standards and practice, which I'll focus a little bit more on, there is a lot of green finance. We think there's a lot of rules and standards that are being developed, but there is still, it's as clear as mud in terms of what we should be investing in and what those clear investable pathways are. So green finance is going into areas that are not compatible with where we want to take our green energy opportunity. And a lot of the green finance is being done is not going to that highest impact. So if you think about prioritization, finance will flow where it's easiest or where the return on investment is highest. It's not going to flow necessarily into areas with greatest impact. So a lot of capital is flowing into what is ostensibly a good green asset, but maybe it's a green building in a city. A lot of capital, we all love investing in green property. That's not a bad asset, but where's the biggest impact in terms of unlocking the decarbonisation for our green energy transition? We need to have more capital flowing to those areas, and it's currently not going there. Particularly our hard to abate sectors where the opportunity is larger. So the decarbonisation of our industrial systems, there is very little green capital flowing towards those areas. So we're like, why? Why is this capital not flowing where it's needed? And we sort of come up, and this is not sort of at all completely comprehensive, but at least within our wheelhouse as we conceptualizing, and from the financial services sector, what are the range of barriers that are happening to that are stopping that capital from flowing? Of course, there is a lot in that policy and regulation and incentives bucket that we can start to tweak, and this is just in the area of really capital flowing. So we do need a stable policy environment. I think everybody talks about it. It is financing 101. A clear and stable policy environment is the necessary, not just sufficient, but necessary underpinnings for us to be able to ensure those flows of capital grow over time. We do need to start really thinking about what the price and market distortions are, both in terms of brown subsidies as well as green incentives, right? And then there's a whole lot of kind of very nerdy, techie, finance sector regulatory things that we work on every day. But the most important being, and sort of people know about it, is kind of this concept of index hugging, where everybody just wants to make sure that they are outperforming each other, and so they all coalesce around the same things, and it's on a very short-term basis. So we're not thinking about an investment now that's going to be bearing fruit in the long term, even if there's going to be a dip. We're just thinking about what those short-term returns look like, and there's a lot of incentives that encourage that sort of index hugging to happen. But an area where we've been focused on a lot, and Peter mentioned, as we partner with the Australian government on the development of the Sustainable Finance Taxonomy, that will be released very shortly in June, and we're very pleased that we're working with government now that it has been returned on what that release looks like. But really in that market's practice and standards, so what is that baseline definition? What should we be investing in? Clearly, there are still uncertainty around where we need to get to in terms of the pathways. There is a lot of greenwashing still going on in terms of the identification of what we should be investing in as green and labeling it as such. We really haven't cracked the nut of what the transition looks like, and this kind of goes hand in hand with that increased financed emissions. So a lot of financiers are saying, I need the emissions intensity of my portfolio to go down, but leaning into hard to abate sectors and making investments into the decarbonisation of those sectors is inevitably going to, in many instances, be a short-term increase in your financed emissions before it goes down. And so how do we get the finance sector to have the courage to lean in and make those investments, and particularly where we are not yet seeing those demand signals for that end product? So a bit of a chicken and an egg situation. So we're at ASFI are working on all those key things. I'm going to focus a bit on that kind of credible investable definition piece. But just sort of before I kind of dive into the standards and the practice work that we're doing, just thinking a zoom out and how all of this fits together as a whole. So if we think about our high level objectives, like we said, our laser focus on mobilizing capital to support the green energy transition and capitalize on those opportunities, and we think about the finance system almost as an enabler. So the market and our, the money that we have, it's there for a purpose. It's there to do a certain thing. It's not an end in itself. And the regulatory architecture that we build around that, I kind of refer to it as almost like the pipes in a plumbing system. And if the regulatory architecture are the pipes, you want those pipes to ensure that the money or the water, the money flows as efficiently and easily as possible, and it flows towards the areas that we want it to get to. So all of those dark green boxes around sustainable finance policy and regulation, their key objective is to ensure that capital flows to where we need it to get to. It's about the kind of the plumbing, I guess you could say. And so it enables really better decision making around risk and opportunity. What it doesn't do is it doesn't change the risk-adjusted return on investment. It helps you to price your risk and price your opportunity, but it in and of itself is not going to shift the dial. And this is where that kind of interconnection between, you need all that information, you need to understand what your risk looks like, you need to understand where that opportunity is, but then you need complementary government regulation, whether it's sticks or carrots, and a combination of a whole lot of different things that will help shift that return investment profile and shore up both, whether it's a supply problem or demand problem, sometimes both, to help shore that up. And so together with the information architecture and the supporting policy environment, that's where you're going to unlock that financial flows towards the energy transition at the scale and the speed that is required. So simple examples are obviously more, you kind of have your baseline regulation, you have your safeguard mechanism, all of these things are starting to put in place that pricing piece. But then often you also need some incentive structures or some de-risking structures, like the work that the Clean Energy Finance Corporation are doing, like ARENA is doing. And I think there's a whole lot more in that space. I'm not going to touch too much on that today. Probably this audience knows better than me the many, many mechanisms that you can have in place to enable those flows to happen. But you actually need both pieces working together to make that happen in a way that is impactful and meaningful, so we can seize on the opportunity. So focusing now on the information architecture or the plumbing of the financial services system to get money flowing to the green energy transition, the Australian government did come up with a sustainable finance roadmap that they published probably now around 18 months or so ago. And they kind of built on three key pillars. And the main one, which kind of gets to that definitional point, like what should we be channeling capital towards, that improved transparency, that is where the work that we have been working with the Australian government on, the building of a sustainable finance taxonomy. So what this does is it really helps investors kind of with a very clear-eyed, they've now price their risk through their climate disclosures, they've set their targets, they've got to put in place a transition plan, and now they're like, well, where should I be allocating capital towards? And this is and really to get to where I need to go, and this is where that definition system goes. So what these do, green standards, they provide a robust kind of system that is helps capital to really be purposeful in terms of its placement to ensure the genuine transition of activities towards decarbonisation. So you're starting to hear a lot from the financial service sector, particularly asset owners. They talk about their climate solutions and they have climate solutions target. This really is that shopping list of climate solutions that are available for capital allocators to move funding towards. So it creates this common language system. And if you think, and this happens a couple of different ways. If you're a bank and you want to align your portfolio to a certain target, you need to have conversations with your institutional clients. You need to be talking to them on the same language. So if they're in the energy sector, we need to be on the same page in terms of what that transition looks like, what the investable opportunities are, so that the banks can say, how can I help you fund that transition? If you're an asset owner and you're talking to your asset manager and you're saying, I want to increase my portfolios and align a whole portfolio with climate solutions, you need to have a conversation with your asset manager and say, these are the types of areas that I want you to start to find investable opportunities for me in. So it's a common language system. It also then supports disclosure and credible transition plans, because it helps you identify what your opportunities are, and it helps you provide sort of meaning to corporate transition plans. If a corporation in a key energy transition sector or hard to abate sector says, well, this is where I am today, this is where my emissions intensity is, can't do anything about that now today, but I want to, over the next 10 years, transform my system. What are the capex allocations that I need to be making? And the easier or the more they're able to tell that coherent story, and that's the same coherent story that funders and financiers and investors understand and know, the more you can start to match that up with sustainable finance, whether it's through a sustainability linked loan or a bond or other kinds of raising, or in key equity investments. So what it does is this common language system starts to create really reduce transaction costs and gets everybody sort of on the same page in terms of what's needed for investors. This is just a quote from someone within the sector. So, without a taxonomy, it's really a best efforts basis. Everybody's trying to do the right thing. Every single individual capital allocator has to have their own framework in place. We all got to be talking, we all got to be drawing off different things, but it's not, if we're really talking about a collective effort at the scale and the speed required to capitalize on the opportunity and get where we need to go to align with a kind of the science of climate change, then we actually need to be a little bit more coordinated than everybody doing their own thing. So just briefly, sort of what the process for the Australian taxonomy, which was the last 20 months up until February of this year. We delivered it to government on the 14th of February, and like I said, will be released in June. It was a mammoth effort in terms of collectively seeking to understand and identify what this opportunity set is across key sectors of the economy. So the Australian taxonomy covers more than our basic energy, but at the heart of it, and we used the IEA's energy models, because at the heart of everything in terms of the decarbonisation is the energy transition that flows through to the new demand sectors and minerals, metals, etc. It flows through to the decarbonisation of our industrial processes, and also flows through into things like our residential and energy use, etc. So we worked with 25 leaders that were the independent decision maker of the taxonomy. We had 8 advisory groups with 84 experts across a range of different areas, working through different workshops and 2 submission processes to actually build technical screening criteria, or kind of like performance criteria at the activity level across 6 sectors of the economy. Here is the opportunity suite. So if you are a corporation, if you're a miner in the Pilbara and you want to decarbonize your activity, we've identified areas in your field of interest that you can actually say that this is going to help me decarbonize my processes. And we've done so across the energy sector, the mining, minerals and processing sector, manufacturing, agriculture, built environment and transport. I won't touch too much on that, but there are some really key underpinning principles that drove the definition. So this is not really what is the most economically feasible. We did take the approach of a science base. So what do we need to be investing in? So what is that objective benchmark of where economic activities need to be aligned with our sustainability objectives, and then what is the pathway, the investment pathway in order to get that. So instead of saying, okay, well, how do I fit my existing activities into aligning so that I can look green, and so we all know that none of us are green right now, none of us are on the path, otherwise we wouldn't be here in the first place. But in terms of our forward-looking CapEx, our forward-looking capital allocation to fund the transition, what are the steps and what are the investments that we need to make? Of course, there's stuff around making sure that the framework itself is usable, and data and information, and this is where things like carbon accounting and the the government's guarantee of origin. All these things are going to be super important to helping us to identify and track the performance of the activities that we invest in. So that usability piece is pretty crucial in that. Making sure that we are aligned with international capital frameworks, and then making sure that, you know, we cannot cover everything. The taxonomy absolutely does not cover off on the whole Australian economy, but so prioritizing where those big levers are. So where's that impact for us to be able to do? And really what a taxonomy does is it identifies environmental objectives that we want to achieve, climate change mitigation being key. It identifies those 6 key sectors. I think it's over 75 activities across those sectors that we then apply a performance threshold to. And if you comply with that performance threshold, as an investor, you have confidence that the things that you're investing in are actually going to move the dial in the economy. So how does this all kind of fit together? So we are, like I said, science-based. We, at this point, this version of the taxonomy, we actually took 1.5 aligned scenarios, starting with the IEA. It is a very informative model, the times model that helps us to actually construct the decarbonisation of the energy system and how that flows through to different parts of the economy. And then, of course, very, very lucky in Australia to have the Climate Works Centre that, you know, they jointly, that the Oz Times model, the Climate Works and CSIRO developed together, which enables us to have that downscaled or Australianized version, and for us to be able to see what that looks like in Australia. We also, you know, had other models and inputs that we use, but as you can see on the screen, they all kind of come out in the same way. You know, sometimes that the steepness of the curve is slightly different in the beginning years, and that does make a difference. And so we did always kind of take the more generous approach, because there are a lot of factors that come into new investments, including sort of asset investment replacement cycles, and, you know, when that's happening, you know, there's a pipeline of demand for new decarbonisation. So decarbonisation of trucks, for example, you know, the order book is full. What does that mean, you know, in terms of trying to get there in the right time? But we know that where the direction is going, and we know what all the component parts are. So what makes up this model? What are all the investable economic activities that underpin this model on a least cost basis? So from that perspective, the model does identify the economic activities that you can invest in that primarily will help you to decarbonize in a least cost way. And so is the most economically rational way to decarbonize your activities. I won't go through this complicated thing, but really what we did do is think a lot about not only how we identify green economic activities, so activities that are aligned to a net zero pathway, but what does that transition pathway look like? And our only kind of starting point was we're not going to be focused on economic activities where we know in a decarbonised world that demand for those activities is going to be gone. So we're not focusing on those activities. What we really want to do is focus on activities that are going to have a stable or growing role, where we need to decouple emissions from production. That's our starting point. So for those economic activities, what does green look like? What does the enabling environment look like? And then what are the investable economic activities that are going to help decarbonize that activity from within? And this kind of flows through. So there's different types of green classification. So key economic activities where there are zero emission substitutes, renewable energy being a primary example. Go for your life on those. High performing economic activities where there are no low emissions alternatives. So what does best in class look like, and where should we be aiming to in terms of performance while we still figure out how to decarbonize these activities? And then enabling activities like electrolyzers and solar panels and all the different little bits and pieces which are not high emitting in and of themselves, but are key enablers to unlocking the energy transition. But importantly, the transition focus is what we're calling these decarbonisation measures. So these are for activities, let's say steel is a very good example, where we need steel, we're still going to need steel in 2050, 2070, 2080. We know that there is no net zero on scale at economic cost right now that we can do, but there is a whole lot that we can do. So what does that decarbonisation of those existing activities look like? What is that pathway? There is a steel industry, and it's looking at that CapEx pathway, including research and development and really kind of prospective technologies. We need to encourage investment into that, and that's where this kind of decarbonisation conceptualization comes in. So what that kind of looks like, and this is just an example of the criteria in the taxonomy. If you're green, so if you're a new activity and you refining copper, lithium, nickel, all the important things we know we need for the energy transition, look, this is what the science tells you your emissions intensity needs to look like. But if you are those activities, wherever your starting point is, the decarbonisation measures is a whole lot of capex and investments that you can make right now that'll help you decarbonise your refining activities. And that's where we actually see in those decarbonisation measures as the next 10 to 15 years as being the primary lever and the primary area where the private finance can help fund the decarbonisation of these activities. So sort of taking you where you're at, leaning in, whether you're a high emitting or not, and working between the finance sector and the real economy to decarbonise existing processes. So now kind of going over time, so I won't talk too much, just kind of just shows you how it all sort of fits together in terms of government policies like the Future Made in Australia can really catalyse that thinking around supply and you know, there is also on demand side measures that the government, I'm sure, are working on. There are all the kind of hygiene or technical bits and pieces that help us to account for this stuff. But then the what good looks like or what we need to be getting to, that's where something the taxonomy really provides that foundation. I might just very quickly touch on electricity sector in particular, because what we've really seen is we have a lot of clear understanding of where we need to get to, and you know, not only through our science aligned scenarios, but also the work that AEMO has done, and particularly in the east, but I do understand there's similar work going on in the west with the Swiss. And what that does do is really help provide that investable pathway. It does throw up quite a few complexities, like what is the role of gas in terms of firming, renewables, and how we kind of unpack this, because we know that we need to increase capacity, or at least this is what AEMO is saying, but we're going to decrease the utilization. And how does that make sense to an investor who's really not looking at things at a systems level, but looking at things at an economic activity level? So some of the work that we've been doing in the taxonomy in this space is to really think about kind of the supporting advice or framework that investors can use to address this issue of when is it part of the enabling environment to be investing in things like backup firming that is still a fossil fuel, but that is going to help drive the decarbonisation of the energy system as a whole. And there's a whole piece of work. So I won't go too much into that, but really I think what this work does, and using the scenarios as the basis and that kind of where we need to go to, is that you actually can start to unpack thinking about the role of the different investable opportunities, whether or not they are enabling the decarbonisation, and you can make some strategic investment decisions based on that. So I might stop there and you know, open up for questions. Thanks.
We did start late, so you could, you know, I was giving you a bit of leeway there, so it was my fault or my. But hey, thank you so much, Nicole. Obviously, you've sparked so many questions in my mind, and even your reference to the, I suppose, really focusing on the impact. It's something I think we talked about before with Kelly Shue from Yale. That idea of, yes, we can always invest in green, but how do we actually? Is it better bang for your buck to help those brownfield move across? And I think it's a really interesting dilemma when we think about that. I'm going to ask sort of an opening question, then I'll get to the ones in the chat. But you know, you've really outlined there's some huge opportunities for sustainable finance. But I guess the big thing is, how do we move the dial to move it urgently? Because in my mind, this is the problem with everything going on, you know, the poly crisis that we're situated in. You've touched on it, but how do you think the taxonomy situating now will help move that forward, the urgency side?
Yeah, look, and like I said, we are one piece of the puzzle. So take what I say within that context. We're absolutely not the silver
the most
bullet.
important, right?
Everyone's the most important.
Finance does help.
But it absolutely does help. I think when we were conceptualizing a green and transition taxonomy or capital allocation framework, because that's what a taxonomy is, we did a 14-month scoping study and work, and we worked with, I think it was over 75 financial institutions and others across the board to kind of unpack some of these questions, like what are the design elements for this key area that we can do to enable that flow to happen, to get your biggest bang for buck, right? And transition was the area that everybody focused on. They were like, we need to find a way to enable finance to flow towards a transition, and in a way that they can see through to the outcome, right? Because efforts that had been made to date around defining transition finance or putting up a kind of framework to invest in transition got quite stuck on what an intermediate threshold looks like. So if you're green, we know, say, you need an emissions intensity of X. Then it was like, well, what does transition mean? Does it mean that you can have an emissions intensity of Y, and that's better than an emissions intensity of, current status? That's not very helpful for financiers, because it doesn't tell you what the end point is. So, we spend a lot of time really conceptualizing, what does transition mean? Transition is not a destination, it is movement, it is shifting something over time. You're moving away from something and towards something. And so how do we actually help the finance sector to identify what is genuine transition, where they're going to get that impact at the end of the day? And so really, I think when we look at the model and how it fell out, it's quite simplistic in the end point, but it was a lot of mental gymnastics to get there, in terms of, firstly and foremost, everybody's looking across the whole economy. Okay, do we need to kind of define transition for absolutely everything? And so one of the first things was just like, no, let's just start with what we know we still need and we need to transform. So that kind of narrows down to get to that impact piece. And then thinking about, okay, look, if we know as a sector as a whole, you need to get there, what should we be encouraging, right? Should it be like it's an all or nothing approach? You need to meet this emissions intensity threshold. That's really hard, and it doesn't help capital to flow. So we spoke with a lot of different industry, particularly in some of these hard to abate sectors, and they're talking to us now and they're saying, I've got an asset that is going to be going for another 10 years. I need to sweat that asset to remain economically viable. I need to be thinking today about what the next thing is. And so I am investing in the R&D to get me there. In the meantime, I've got another 10 years and I want to be decarbonising this asset. And so really thinking about, okay, what does that investment pathway look like for that sector, both in terms of the next plant that they'll be investing in, which needs to have a significant jump down, but the decarbonisation of that processing and steel, etc. So that was, I think, where, and what the feedback that we got from the finance sector is, this is going to be a game changer, because it is going to help enable a more sophisticated thinking around financed emissions, and being able to tell a story that will help them to lean into heavy industry. Not everything. It doesn't mean you can continue to invest in every high emitting area, but what if we're on the journey to help decarbonize those industries that are going to be those growth industries for the future? What does that look like, and how can we partner with our clients to get that done? So we're hoping that will play a small part in increasing the pool of finance that's available to decarbonize these key sectors.
Well, it has the potential to play a large part, actually, I think, in actually crystallizing it, as you say, and then taking out the uncertainty and de-risking for the finance, which is so important. I'm going to go through some of the questions. I've got others I really want to ask you, but this is a short and sharp one that Tim Bateman said: is investment in ASFI required to return a profit, or can some of it be used to invest in industry decarbonisation, R&D? So I guess just, clarifying the structure of ASFI and what its goals are. Yeah.
Yeah, so we're a not-for-profit organisation. we get funding primarily from three sources: member-based funding, which helps kind of keep the lights on, project-based funding from philanthropy, and then the work we do with government, which is funded. So the taxonomy itself was completely funded by government, and we saw that as very appropriate because it is a rule set that is there for investment going forward. So ASFI itself don't make investments. We are just an enabler to help shape I guess what's needed to change in the system, and play that role, that bridging role between government and the finance sector to work together to make that happen.
The guiding light, yes. So I won't go into full detail, but Richard Watson, obviously everyone has these different technology preferences and so forth, and electrification being the end goal. Richard talks about hydrogen, and how do you, with the potential global warming potential of times 12, so there's a focus on hydrogen for transport. Is that, the best use of dollars and things? So I guess what he's asking is, in this way, how do we make sure the capital that goes is aligned to the end goal? Like in his mind, his electrification over hydrogen transport. Do you have a view on how the taxonomy can help with that, I suppose?
Yeah, look, I mean, there was a lot of debate in the working groups around to what extent the taxonomy can nudge people to make to use the what are essentially pretty big decarbonisation levers in a way that is optimal. So that's sequencing. So should we be using hydrogen to feed into a residential network? Probably, definitely not. Should we be using hydrogen to generate electricity? Definitely not, right? Should we be using hydrogen on site next to a heavy manufacturing process that is the solution to decarbonisation? Probably yes. So, but because the taxonomy is bottom up, so activity, really it's just a shopping list for the future, what we like to call it. It doesn't necessarily put all those different pieces together. So it'll describe what green hydrogen should be and what the performance threshold should be for hydrogen, but it is not that, it doesn't give you kind of a direction on where you should be using your hydrogen for. What we do and where it kind of all fits together is because we use an economy-wide decarbonisation model, and then we look at all the decarbonisation levers from the bottom up, that makes up that shopping list. All the levers in the manufacturing sector are clear and correspond then to all the inputs that need to go into the decarbonisation. So low carbon liquid fuels. In the transport sector, we're very clear around where that is a main decarbonisation lever. If you're a transport organization and you want to sort of get green operating expense claims, but then in the manufacturing sector we'll describe how you should make low carbon liquid fuels to ensure that it is aligned. But we don't, I think, get to the level of really prescribing how these things could fall together. And you would, like, it's an open debate, but in a lot of instances, like most of the advice that we got back through the working groups, is the economics will sort that out. I think because we're talking a lot still in the hypothetical, because industries are quite new, there's a lot of kind of things going around. But I think in the cold, hard light of economic day, we will be using that stuff where its highest value is, because it's just going to be too expensive to use it anywhere else. So I think we have to maybe trust the economics on that, but the taxonomy can't unfortunately solve for that.
And we'll start to see it through the investments of CEFC and ARENA and the knowledge brokering of the case studies that emerge through all of
100%.
those, I think. I'm just going to go to another quick tech one and then go back to these broader ones. So Rosie Johnson asks, do you have a view on CCUS projects and investment?
So, I mean, I think CCUS as like something, an activity that you can invest in, we have included that. And again, I think that the role of CCUS is going to be an economic question, right? So for the electricity sector, for example, in Australia, every single model is just abundantly clear about what those levers are going to be, and that technology does not feature at all. And that's just purely on a least cost. We've got those constraints if you have to decarbonize in according with a temperature goal, so a carbon budget. But within that, it uses an economic model, and it doesn't come up. But I think there are certain instances where it does come up in the modelling. So very hard, there are hard to abate areas in cement and in a couple of other sort of industrial processes where CCUS is going to play that role. It is, very expensive and it is quite complex. And so again, I think like the question around green hydrogen and others, I think all of these solutions are going to play a role, but whether they play a role in major decarbonisation or whether they play a role in the last 10% or the last 5%, I think as we make these investments, that will fall out in the wash in terms of the economics. I can say one thing is that, as financiers are not going to finance something that costs, say, $150 per output when something else can cost $20 per output. So if CCS is going to have a future in a whole range of things, it will have to be competitive from an economic point of view. But certainly I think there is a role, and that kind of showing up. Just what role that looks like, I think will remain to be seen.
I might decide around what the price on carbon is as to whether it
Exactly.
becomes
Yes. This is where these other policy
yes,
things really influence,
yes,
the
within the
growth
world.
of. Yeah.
So just going in order, this won't be a surprise. Larissa Taylor asks, what opportunities are you seeing for investment in land and ocean use planning, natural capital protection, restoration, food systems, water through to 2030?
Yeah. So, I mean, we do have a comprehensive set of investable decarbonisation measures in the agriculture, so land sector in particular. We weren't able to cover off on sort of ocean-based systems, within the time period that we had. And there is, I think, many of the financial institutions that participated in the taxonomy development process, but also are looking to use a taxonomy, have a keen interest in thinking about how they can use this as part of a solution set that they will offer to their clients and customers to help decarbonize that part of their portfolio. It is the one area that all of, I think, our financial institutions or banks that belong to the net zero banking alliance, they have to submit their kind of glide paths or their decarbonisation pathways, and there is currently no solution to agriculture and land. So I think there's a lot of people leaning in, but it's quite nascent in terms of we don't have the data, we don't have the emissions, we don't even have a baseline to start with in many instances, we don't have an emissions reduction expectations, and we're not quite sure how much heavy lifting the land sector can do. And I think we need to get better at integrating sort of holistic land management practices, looking at land management as a whole, as almost like a contained unit with sequestration and emissions reduction that will have implications for offsets that are used in other parts of the economy. So I think some of those complexities that the taxonomy can't necessarily solve for, but we have tried to identify, at least in the first instance, a whole bunch of practices and measures that can be done or encouraged through investment on the land sector that will help decarbonise.
Thanks. So this one moves on to banks, which you sort of touched on. So how are the large banks and those with access to private capital responding to these development of the standards? And is it generally going to change behaviour towards investing at the current practice with green loans? Also, as they say, current practice is to still run the standard risk assessment over sustainable projects, which make them less viable.
Yeah, look, I mean, I think firstly, in terms of the reaction, this was, ASFI as an initiative was driven by, a large cohort of the finance sector, including all of Australia's large banking institutions. They are also our members. They were very actively involved and supportive of the standard, because if you think about like what the standard does, that common language system is very helpful. It is extremely expensive and extremely difficult to each person go and define what green means on their own. And of course, you have seen, and I think rightfully so, a huge kind of crackdown on greenwashing from the regulators, which has introduced a whole lot of caution into the system across banking and investment. And so a common kind of identified government supported standard is seen as, definitely something that can help move the dial. I think we're not at the stage where the standard itself is going to change the kind of risk lens that financial institutions pass over investments. So, it is still quite difficult to get substantive green premiums unless you're you bunching up a whole, you do see that greenium come through in a price differential, but how meaningfully that is to really shift the dial, I think is difficult, because you have a whole lot of banking regulation that still sits behind it. You have responsible banking, you have capital weightings, you have other complexities in the system beyond just the standard, which means that the amount that they can move to adjust the price of capital to provide a discount for green lending is limited to some extent. So there is a lot of thinking around how you can increase that greenium through sort of, the work that the CFC does to wholesale products. And so I think you're going to see the taxonomy used in that way a lot more. So the CFC providing more products that are taxonomy aligned, they can wholesale that. The discount that the banks can give plus the discount that the CFC can give provide something quite substantial. But I think more thinking needs to be done in that space. So there's other incentives around the system to really make it impactful and to the dial to enable project proponents to get a real discount.
Yeah. Greenium, new term I've heard. I'll put that into my back into my back pocket. That's obviously a new financy thing, but obviously not. I'm going to keep moving on to that, and then I'll go back to Melissa's question, because I guess I'm thinking about, and this is in the global context, and Mark Carney in Canada, where we're at. How does Australia, how does this help when you think about the global context and so forth? How does it uplift, or where does it align, I suppose? I mean, and just more thoughts on where we're at globally with the state of play, I guess.
Yeah. So I think a couple of months ago, everybody was feeling a bit doomy and gloomy. And there was a bit of a reckoning in terms of kind of, is the developments that are happening in North America going to be an existential crisis to what had been many, many years of quite a lot of momentum building, galvanized through the work that Mark Carney did in COP26 to get GFANs together, to get the ISSB going, that then put it on the radar, and we're seeing, regulated disclosures throughout the world. But now that things are sort of settled and we sort of know where everything lands, and I actually, can't overemphasize that the stable and supportive policy environment in Australia is pretty crucial in this, because what you're seeing is a whole lot of different areas continuing to stay the course. And I think that is going to create an advantage for these jurisdictions in the future. So I think Mark Carney's appointment as Prime Minister in Canada, we've been working very closely with Canada in terms of sharing approaches to transition. We have very similar, I think, outlooks in terms of where and how we want to shape the sustainable finance agenda. You have Europe, who are staying the course. Yes, they are simplifying, and yes, they are going through the process, but there is no indication that they are stopping what they're doing. And then you have Asia, which is just going gangbusters in terms of really looking at how they can finance the transition. This is, we can be on that side of the equation, and I think really capitalize on the opportunity. So I think Mark Carney's presidency, the continued and renewed commitment from Europe, and the signaling from China, from Singapore, from Asia region to continue with this agenda means that Australia is just in prime position with our policy agenda where we're at to capitalize on that. So, I think notwithstanding what's happening in the US, I think it'll be their loss and our gain, and creates a whole lot of opportunities as well for people to come and invest in us and the things that we're doing.
Yeah, I guess I was excited just because he was so integral to the earlier financing across,
And
the globe.
yeah, and he does, right? He is the architecture of the TCFD, right? So the
Yes.
cost and the climate disclosures. He really understands the power of finance and
Yes.
the regulatory architecture, that plumbing system. He understands how that works, and so I think you can anticipate that the support for that agenda through the different forums, whether it be the G20 and other areas, will continue, especially if you have Australia, Europe, Canada, and China and others that are all pushing in that direction.
Fantastic. Got time for one last question. So from Lisa Teed asks, can you expand a little more on how the taxonomy flows through to residential and energy use?
So we classify economic activities across the construction and building sector across a whole. And we look at it across the whole building cycle. So that's when something is constructed, when something is operational, when something is upgraded, and then all the enabling infrastructure. So that's sort of how we deal with it in that context. For residential in particular, the things that go in, and so the financing of the decarbonisation of your homes, all of that is, investable economic activities. And we worked really, really closely with the CFC and others to ensure that, the government's, I think 1.5 or whatever $1 billion energy efficiency fund that they provided to the CFC, that we were able to ensure that the taxonomy makes that live, so that we can put those two together and products can start to be offered to the market. So really what we are looking in the energy in the building and environment sector, we need to decarbonize that sector, we need to electrify that sector. That is the clear pathway, and so we've really created definitions and economic activities that enable that to happen, both for new and then how you get there for existing buildings.
Fantastic. We've come to time, so we're going to have to stop there. But honestly, thank you so much for taking the time out, sharing the work. I mean, here at Curtin, we're really interested in tracking where that goes and what happens. And I think, it's just such a critical time for this. So we're really pleased to have had you be able to host you. So thank you very much.
Thank you so much, Peter. It's been such a pleasure engaging with you and with everybody on the team.
And thanks everyone for attending. We'll keep in touch. Thank you. Thanks, Nicole. Take care.